And part of the problem for gold and silver is the secrecy. I mean, it's one of the values of gold and silver, and we love gold and silver because they're secret, and you don't have to disclose your ownership and holdings and your buying and your selling to anyone if you're dealing in the physical market. So the secrecy is a big value, but it's also a big hindrance because as a result, in the absence of good information, bad information takes over. Good morning, it's Jeffrey Christian. It's about 10:10 on Tuesday, the 20th of June here in New York. I want to talk today about topic on the screen. Gold and silver investors are groomed to fail. Not all of them, but a lot of them. A lot of people who invest in gold and silver have been conditioned from their earliest days to believe things that set them up to lose money in their gold and silver investments. And it's not an accident. A lot of the people who offer precious metals based on fear and misinformation actually are financed by the same people who finance all of the other garbage that you hear about social and political and economic ills. And it's a part of a system designed to separate investors from their money. Now, before I get back into that a little bit, let me tell you two anecdotes from my career that relate to this. The first one has to do with Peter Monk and Barrick Gold. Peter created Barrick Gold around 1983. Price of gold had gone from $190 to $850. It had come back down by 1983. It was trading around $300 to $360 in that range. And the profit margins of running a gold mining company were enormous. They were like 100%. The cost of producing gold, depending, the average cost of cash cost was probably around $120. So you had more than 100% profit margin. And Peter, who was a business person, said, I have to get myself a gold mine. And he created Barrick Gold. And he ran it for several decades. It became, for a while, the largest gold mining company in the world and definitely the most profitable. Toward the late 90s, the board decided to stop hedging. And Barrick was one of a handful of companies that had really knowledgeable financial managers. Barrick raised about $3 billion from 1983 to, say, 1998, and used that money to build gold mines and buy gold mines. And it made and sold about $3 billion worth of gold using the $3 billion of money that it had raised in the markets. It had made another $5 billion or so, don't hold me to these numbers, by hedging effectively. And the fellow who was running Barrick at the time, Randall Oliphant, is one of two people who has taken a hedge that I structured for clients and improved upon it. The other person is Carlos Sanchez, who does our hedging strategy work for our clients now at CPM Group. He's been with CPM Group since 1999. Barrick was an extremely well-run company. It was being penalized by shareholders because there was a witch hunt, and it really was a witch hunt, not a made-up one, against gold mining companies that hedged. If you look before Peter Birch and his predecessors started the anti-hedging witch hunt in gold mining, if you looked at the way gold mining companies performed relative to whether or not they hedged, if you looked at their operating performance, hedged companies did better. And if you looked at their financial performance, their share price and their share price relative to other companies and other metrics, it was pretty much indistinguishable. the beta, the correlation that you could see. Are mining companies that hedge or don't hedge penalized by investors? Was nothing. After the witch hunt started in the mid-90s, all of a sudden you started getting premiums on companies that didn't hedge relative to companies that hedged. So you had management, in the case of Barrick, it was really top-notch management saying, it behooves us to hedge from an operating perspective. We make money hedging. We don't really make money mining gold. Other companies would say, yes, we make money mining gold, but we make more money if we hedge intelligently and effectively. But the financial markets were penalizing companies to hedge. So the board at Barrick decided to unwind its hedge. And in so doing, it lost a few $1 billion. People who don't know the history will say, well, Barrick lost a few $1 billion, a couple $1 billion because of its hedges. No, Barrick made billions of dollars because of its hedges. It lost a couple billion of it by virtue of people not knowing what the hedge book looked like and unwinding it ineffectively. Now, my anecdote has to do with Peter Monk, genius who created Barrick Gold. And around 2010 or so, Barrick's new management, he had retired and moved on, and Barrick's new management said, we're going to accelerate unwinding our hedge book. Exactly the wrong time of the market, but that's beside the point. And they made that announcement. They made it at the Denver Gold Group in September of whatever year it was. A day after that, I actually left Denver early to come back to New York because there was a luncheon honoring Peter Monk as a great Canadian business person. And during the question period, somebody said, Peter, you created Barrick in 1983 at the beginning of a large bull market in gold mining. You had maybe 27, 28 other companies that were created at about the same time, and they've all failed, but you succeeded. And Peter's response was very telling. First off, he said, those companies did not fail. Many of them were very successful gold mining companies, and they built up good companies. He said, but the reason they don't exist anymore, and quite frankly, in the ensuing decades, Barrick has bought 27 of them. And we bought them, and we've done better financially because we hedged. You see, I don't believe in gold. I think of gold mining as a business. I don't expect gold prices to go to $10,000 or whatever. And when the gold price rises, Barrick will hedge, or would hedge in the past. And when the price would immediately fall back, we would unwind those hedges sometimes and take our profits. But those other companies believed in gold. Their managements believed in gold. Many of them didn't hedge. When the price of gold rose, they would borrow as much money as they could and use that money to buy overpriced gold mining assets, the value of which, or the price of which, had been driven higher with the bull market and gold prices. And when the gold price inevitably fell back, because that's what it does, because it's a market, when the gold price falls back, they would be in financial straits and we would buy them at a discount. So it's not that it's because I don't believe all the nonsense about gold, and because I make wise financial decisions that Barrick has done well. That's the first anecdote I have. Here's a man who was not groomed to fail in gold. He was groomed by virtue of growing up as a Jewish person in Europe during the rise of the Nazis. He was groomed to be intelligent and to find ways to make money regardless of a hostile economic and political environment. My second anecdote had to do with Sir James Goldsmith. Sir James was probably my favorite client I ever had. Sir James was an adamant gold bug, some would say, in that he believed that gold had a very important role to play in the international monetary system. He believed that gold ultimately had to be part of the international monetary system. We disagreed about that, and we had these wonderful conversations. But Sir James called me up one day in the late 80s, and he said, I was talking to one of your clients, a large hedge fund, and I was saying that, I'm sorry, I have this backwards. He was talking to he was our client. He had come to us because he wanted investment advice on gold. And he came to us one day and said, you're the gold guy. I want to talk to you. And we started saying, okay, you're a gold bug, so you're long gold. He said, no, I'm not long gold. This was the late 1980s. Gold prices had risen from $280 in 1985 to $500 at the beginning of 1988, and it had fallen back. It was trading around $320, $340 an ounce. We had issued a sell recommendation at the top of the market in January of 1988, saying $500 is the cyclical peak. And we're looking, these are the 5 reasons why we think the gold price is going to fall for the next 2 or 3 years. And these are the 4 things that we're looking to see change in the market and in the global economy before we issue a buy recommendation. So he called up and I said, okay, we'll be your client. You're a gold bug, so you must be long gold. He said, no, I'm short gold. I said, okay, you believe in gold? He goes, no, I don't believe in gold. I believe that gold should be the basis of an international monetary system or somehow or other involved in an international currency regime. But I don't believe in gold the way gold bugs do, that it can only rise, and that any time the price declines, it has to be because there's some grand conspiracy driving the price down. I look at the gold market, and I've read some of your research because one of your clients gave it to me, and I happen to agree with you in terms of the economic environment and the gold supply demand right now, and so I am short gold. Gold bug loves gold, sees it as integral in the international monetary system, shorts gold. He actually bought a gold mining company, controlling interest, about 49% of a gold mining company a few years later. And then he actually sold it for some out-of-the-money gold calls that had become extremely profitable from another company. Those are 2 people who were not groomed to fail. But so many other investors, first off, Americans and most other people in the world don't learn financial management and financial wisdom in school. We don't have home ec anymore. We don't have basic economics anymore. So people learn how to read, they learn how to write, they learn how to do computer code now because that's what the world needs in terms of employees. But they don't learn how to live their lives. They don't learn philosophy. They don't learn civics. They don't learn what it means to have a child and raise a child, and they don't learn finance. And so they turn to what's available to them in the media, and they hear just gibberish. Oh, the world, when the dollar becomes worthless. It just doesn't make sense. There's so many things that these people believe, and they set themselves up, or they are set up. They are conditioned to set themselves up to lose money because they don't understand that gold and silver are markets, and they're commodities and they're financial assets. The prices rise, the prices fall. The prices respond to macroeconomic conditions, to political conditions, to financial market conditions, and to supply and demand fundamentals. And part of the problem for gold and silver is the secrecy. I mean, it's one of the values of gold and silver, and we love gold and silver because they're secret, and you don't have to disclose your ownership and holdings and your buying and your selling to anyone if you're dealing in the physical market. So the secrecy is a big value, but it's also a big hindrance because as a result, in the absence of good information, bad information takes over. So much of the supply-demand statistics you hear about gold and silver are just wrong. Years ago, the London market used to have published these gold lease rates and gold forward rates. And they were indicative. They were calculated by taking the LIBOR rate and the gold and silver forward spreads and subtracting one from the other. They didn't add the risk premium that the market actually adds to forwards and to lease rates. And they would publish these things, and they were not actually indicative. You had years where the gold and silver lease rates were negative, and we would get calls from people saying, oh, I see that people are paying, gold lease rates are negative 2%. I'd like to borrow some gold and be paid 2%. And you'd have to say, well, they're not, and no one's actually paying anyone to borrow gold and silver, even though the indicative lease rates published by Reuters at the time are negative. No one's doing that. The financial regulators in London saw this. They had gone through the LIBOR. There was a scandal because LIBOR rates that were published were determined by indicative rates. And some of the banks were less than honest with their indicative rates. There was a scandal in the foreign exchange market because the foreign exchange rates that were published were based on indicative rates. And we were talking to the regulators. They were asking our advice at the time, and they said, do you have similar problems in the precious metals markets? And we said, no, because the gold, silver, platinum, palladium fixes were not based on indicative rates. They were based on physical transactions at the fix. Those were real rates. Okay, so that was good. The financial regulators said, we got to clean up LIBOR, which they're still working on. We have to clean up the foreign exchange rates, which they did. And we're looking at these published forward rates and lease rates in the gold market, and they're not accurate. So you, the London banking community, really need to come up with more accurate lease rates and forward rates if you're going to publish them. Of course, the bank said, well, we don't even talk within the bank about what kind of lease rates and spreads we're using, forward rates or forward spreads. And we're certainly not going to share that information with our competitors. Plus, there's no such thing really as the forward rate because the forward rate varies from company to company. If you're a central bank and you want to borrow gold from me, or you want to sell gold to me, or you want to do a transaction, you're going to get a narrower spread. If you're another bullion trading bank, you're going to get a relatively narrow spread. If you're a mining company, you're going to get a wider spread, and we're going to skew it to the side because we know as a mining company, you're more likely to be a seller than a buyer. And if you're a privately owned jewelry company, you're going to get a much wider spread. And it's going to be skewed because we know as a jewelry company, you're more likely to be a buyer than a seller. So there's no such thing as the forward rate. We're not going to cooperate with our competitors and swap notes. So let's stop publishing it. And you went from a situation where you had bad forward rates and lease rates being published to no forward rates and lease rates being published. And it was very interesting because the gold promoters, not the good gold promoters, and there are some, but the people who trade on fear and conspiracy theories, immediately started telling people, oh, gold is moving to a backwardation in London. And we were getting calls from mining executives saying, is gold really backwardated in London? And we'd say, no. They'd say, well, do you have any data to show that? And we'd say, no, because there's no published forward rate. And the published forward rates that used to exist were bad anyway, because they were indicative and they weren't real. The only way you know what the forward rate is if you're a market participant and you go to your bank and say, what's your forward rate for me at this moment? Some mining executives understood that. Some didn't. And a lot of investors didn't. And they still don't. But that's the nature of the secrecy of the market. And it's not because there's some grand cabal trying to control the market. It's because gold and silver are private investments, financial assets, and commodities. And investors don't really get that more often than not. Smart investors do. Sir James certainly knew it. We have a lot of other clients that we know it. But there are a lot of investors who just don't understand this. And we've seen multimillionaires and billionaires who have not only made a fortune in a particular industry, but in some instances actually created the industry. And when it comes time to buy gold and silver, they throw everything they know about studying a market and making an educated decision based on data and statistics and analysis and probabilities. They throw it all out and they buy gold because some guy at a bar or some guy on the internet assured them that gold was going to $30,000 and silver $600. Not the way it is. Investors oftentimes are groomed to be wrong, to buy gold at the wrong time and silver at the wrong time for all the wrong reasons. It's not to say that you shouldn't own gold and silver. And as Lenin said in 1921, when the gold price is low, you should buy gold. And when the gold price is high, you should use gold to buy other things. But I'll talk about that some other time. Right now, we continue to be where we have been. The gold price and the silver price are pretty much treading water. They're moving sideways. We do expect them to move slightly lower over the next month or two, and then probably rise later in the year. That's gold. That's silver, although the title says gold. Tomorrow, for our clients, we will have an open forum question and answer period. So far, we've gotten about 10 or 11 questions sent in by clients. That's probably enough to fill up an hour or two. But if you are a client of CPM Group or a subscriber to some of our services, you may plug into this at 11 o'clock tomorrow Eastern Time. And there is a mechanism whereby you may ask other questions. We'll be doing that tomorrow, and on Friday, we'll talk about what comes next. In the meantime, take care of yourself, take care of those around you, and try to do something good for the world. Thank you.